Hey everybody, Marty Missouri here with your weekly economic update. Going to keep it relatively brief this morning and just jump right to it. In front of you is the graph of our PWA index, and we took quite the fall, 8 points week over week to a negative 27.6 to be exact. So we had several of our inputs actually deteriorate. We only had one that showed improvement. And folks, make no mistake, this explains, perhaps counterintuitively, the big rise in stocks last week, as I've been explaining now here of late, what is inspiring buyers and sellers, which also, as I've pointed out, is why I've been a real skeptic that the big drop-off from July is ultimately that next leg down that we're looking for. Anyway, I've gone into a lot of detail on that in previous blog posts, so I won't do that again today, but I'm sure we'll be broaching that subject in the days and weeks to come. So as for the inputs, oh, and by the way, I'm going to touch at the end, per request, just briefly on the setup for small cap stocks. Auto sales for October came in 100,000 or so less than expected and still running below 2019 levels. Wards said October results were below expectations, apparently due to weakness at the end of the month. Most automakers finished below mid-month projections for each, thus the industry's overall weaker results can't be blamed on underestimating the impacts of Ford, GM, and Stellantis from the strike-related plant shutdowns. The results show that other automakers did not benefit from those losses. In other words, it would be real convenient to say that auto sales were down because of the strikes. Well, actually, they were down for the automakers whose workers are not on strike. Should come as no surprise that mortgage purchase apps continue to plummet. They're now at a 1998 low, believe it or not. Consumer confidence, the Conference Board's measure came out this last week, and it fell to 102.6. We're now back to the lowest since May. Most of the drop had to do with how folks feel about their present situation. Expectations did fall, but less than 1 point. One-year inflation expectations actually ticked up 0.2 from September to 5.9%, which is a 5-month high. The bottom line from the Conference Board was write-in responses showed that consumers continued to be preoccupied with prices rising in general and for grocery and gasoline prices in particular. Consumers also expressed concerns about the political situation and higher interest rates. Worries about war, conflicts also rose amid the recent turmoil in the Middle East. The decline in consumer confidence was evident across households age 35 and up, and not limited to any one income group. Now, with regard to the consumer, though, we really, as I suggested in yesterday's video, have a tale of two consumers. Reading through earnings reports, I won't do that again, but I've got a few more that just basically confirm what I read to you yesterday. And that is that, if we're talking about leisure, they're still booming. And the characters there, the actors there, the producers of those services, leisure, what have you, are still very optimistic. If you're looking at goods, and I'll show you that here in a second with the ISM survey, and retail outlets other than restaurants, they're voicing some serious concern. So, the question is, are we in an environment that is going to see conditions change so that those consumers who are really concerned and really cutting back will start spending again like they were a year ago? Or is this an environment where folks are still in that YOLO, you only live once mode, and are spending perhaps in some instances beyond their means? Now, when we see the savings rate come down, that suggests that they're spending beyond their means, or some of them are. And credit card balances rising hugely. A lot of people have made a big deal out of the $1 trillion in credit card debt for U.S. consumers. I get it. That's a big number. It's never been that big before. But as a percentage of household net worth, it's still relatively small. So folks who just are forever bullish would tell you, hey, that's nothing, because net worth and income has grown faster or fast enough to keep that going. Well, sure, except for the cut in savings and the acceleration in credit card debt in general. It does say something. Now, if we have a recession, and we do think we're probably going to next year, well, then, of course, that $1 trillion, as asset prices drop and as folks sadly lose their jobs, that percentage of net worth and income suddenly becomes a bigger deal. So got to be careful with our narratives, and we have to put everything in the proper context and be a little forward-looking with some of these statistics. As for consumer confidence, as you can see, it's rolling over. No ifs, ands, or buts about it, and that's consistent with our overall economic thesis. Initial jobless claims ticked back up a little bit, 217 from 198, incredibly low. But you can see the trend here, right? And continuing claims are the most since April, nearing the highest since December. So people are staying on unemployment, little pickup here. And folks, you know why we have these lines here is that, you know, you can talk all day about good jobs numbers, low unemployment, low jobless claims. Pretty much the minute they start rising on a trend basis, these red areas are recessions. You need to start thinking about an economic slowdown. And then the payrolls numbers, the biggie that just shot the market to the moon. And I warned you that if it's a soft number, stocks are going to continue that big rally from last week. So 150,000, 30,000 less than expected. Now remember, we had tens of thousands off the job with the auto workers strikes. I think it's like 30 or 40,000, which would have gotten us to the expectation. But the expectation, 180, I think would have rallied the market as well. It's when we had a big upside surprise is where I think stocks would have tanked. Private sector hired 99,000. That's 46,000 below expectations. Also reflecting a weakening labor market was the other metric, the household survey, which actually saw a job decline of 348,000, and combined with a 201,000 person drop in the size of the labor force sent the unemployment rate up by 1/10 to 3.9%. So labor force participation dropped off a little bit, and it's the household survey that actually determines the unemployment rate. So that's ticking up a little bit. Isn't it ironic, though, that as things weaken, and I said I wouldn't get into this, but the equity market rallies. And that is a very dangerous narrative. If indeed things continue to weaken into recession, then we'll have a different conversation about what the equity market would be doing. Another notable part of this report was the continued rise in multiple job holders, which was up 205,000, the most since July of 2019. That's interesting, right? People feeling like they need to hold multiple jobs to make ends meet. And when you go to the store and see what things cost, I get it. And what does that say ultimately about go-forward consumption, I would say? Here's another data point reflecting the job softening, the diffusion index, measuring the number of industries adding workers versus those losing them. It fell a sharp 9.4 points to 52, nearing the break even, and that is the lowest since the COVID shutdown. Folks, we're seeing signs, no ifs, ands, or buts about it, that recession risks are rising. And we're seeing that in the Institute for Supply Manager surveys. So last week, we did a complete about face. We were seeing some real improvement in terms of the rate of contraction in manufacturing for a few months, and you can see that rolled right back over. Below 50 means contraction or recessionary conditions in terms of manufacturer sentiment. So it's been over a year now that per this metric, manufacturing has actually been in recession. Now, services still in expansion, but really slowing the pace of expansion on a month-over-month basis. So something definitely to keep an eye on. As I pointed out a zillion times over the years, typically manufacturing goes first, and then services give up the ghost right near or right when we're going into recession, as you can see here, a little sooner back in the early 2000s recession. Heavy truck sales, a data point that maybe is off the mainstream, but a good one, particularly when you look at it on a rate of change basis. So you can see it's broken down here as well, and you can see how it tends to break down, right, heading into recession. Came close in 2016 according to our PWA index, but we didn't get there. We remained bullish through that, by the way. Baltic Dry Index, it was really ramping up there for a little while. It's rolled over pretty hard here as well. So, a very noisy signal, but short term, not a great signal with regard to the global economy. And then lastly, speaking of the global economy, I just wanted to throw up the economic surprise indexes. Citigroup does this. And so this is what's going on in the economy relative to what economists had previously forecast, right? So above zero, it means that the data has come in better. Below zero, worse. So you can see the U.S. is still up there pretty convincingly, although rolling over here a bit of late. The Eurozone really in the negative, meaning the Eurozone data continues to disappoint what economists thought was going to happen. Japan just slightly in the positive, but rolling over here as well. China just slightly in the positive, but rolling over here with last week's data. Emerging markets in general, everybody, my point is, for the most part, save for Europe, still beating expectations. But you can see that we're beginning to roll over, and you can see how these things tend to trend. Again, below zero would be ugly relative to what economists had expected. Okay, so that's it for the economic assessment. Deteriorating some right here, and I think over the next few months we're going to see this begin to happen at an accelerated pace. Now, a viewer suggested that they had a real good experience in small caps after I mentioned them the other day and showed the chart at how beaten up they were, and asked for me to give my opinion in terms, I guess, the go-forward outlook. So I want to be clear that my presentation the other day was not about saying that small caps are something that should be bought right here. Yes, they look like a chart that could see a pretty nice bounce. And yes, they did get an outsized bounce relative to large caps. And yes, I did say we will be real buyers of small cap stocks when we think the time comes. So I want to be clear that I was not saying at that point that we were buyers of small cap stocks. I just said that we will be, and we will be when we believe that the worst of the recession that we think is to come is over. And here's an example of why. So this is the Russell 2000 RTY S&P 500 ratio. Okay, so this goes up when small caps outperform large caps. It goes down, obviously, when large caps outperform small caps. So here we are coming out of the 81-82 recession. Look at the massive outperformance. Of course, large stocks were going up too. This just tells you how hugely outperforming small caps were. But then notice that in very short order, they began underperforming. Here, coming out of the early 90s recession, a good 3-4 years of outperformance and then underperformance. Here we are coming out of the tech bubble burst, right? Massive stock market disaster, but narrow recession. Interesting. Anyway, small caps bursting out of there. Small caps giving us a signal, toward the end of the 2008 Great Recession, right? And then outperforming for a while. Noisy, but outperforming. Out of COVID, kaboom. So it's not going to be that small caps are going to give us a big signal in and of themselves, but we will watch them and track this very closely. It is really more about the economic data showing that the worst is over, and then scaling in, if not piling in, to whatever our max position will be in small cap stocks. So that's my point there. But I think the question was really on a short-term basis, how does the trade look? Okay, so here's my daily chart of the Russell 2000. And yeah, it was somewhat compelling. And I say somewhat because it could have been better. The S&P looked better to me in terms of assurance of a bounce, but this is a steep falling wedge pattern, right? We did not have a bullish divergence on the MACD, so it was just confirming the decline. This by itself is bullish, but not to me, right? Unless we get something confirming down here. The RSI, though, basically looked like it was bottoming out, coming off of slightly oversold territory. Now, the minute we broke out of that wedge, we got our buy signal here on the MACD, and then it was pretty much, party on. And what a massive move, right? And by the way, just compare this to the S&P. Let's just do a year-to-date here. And you can see this means that, the S&P had a huge week as well. This just tells you how good small caps were relative to the S&P. Still down 12%. more than the S&P on a year-to-date basis, right? Okay, so back to this. So question is, how far can this run? It just, you can see it almost hit the 50-day moving average, and folks began to sell off there yesterday during the day, right? Just look at the other technicals for what they're worth. We had this very nice channel here. We were not really anything to worry about too much here, but man, when it broke, it did break. And this looks pretty much like a bear flag right in here, right? And then you take your flagpole, and that's about right, right? And then you had this consolidation in here. Could have drawn a box around here, and man, you were rolling over big time right here. So this was just about as bearish as it gets, and boom, 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 we bottomed in here. Now you have this long consolidation right in this range here, a swing trader's paradise. But what we're noticing here is, wow, we went down and hit this bottom. Really big bullish divergence. That just told you that this was probably over, at least from a technical standpoint. Broke through what could have been pretty stiff resistance. It certainly was for a while. And then boom, boom, a couple, 3 days, then you're consolidating up in here. Not quite an island pattern. You'd need a gap on both ends, but rolling over here. And so you got a little bit of a sell-off, caught itself right here. And then you had a really nice rally. Although, here you could say, there we go again. You'd be on your toes because it looks like this thing could roll over. Sure enough, it did. Consolidated down in here. Nothing on the MACD that really told you to do anything, although the RSI was coming off of oversold territory with a bullish divergence, yada, yada. So I could do this all day. So if we're concerned about the macro, concerned about the economy, you'd want to be very careful in here. I'm not trading this myself. I'm at least at this point, and I'm not giving trading advice right here. I'm just looking at it and just telling you what I think as I look at the charts. So the individual who asked me to do this is not a recommendation. Keep doing your own work. Sounds like you're doing a great job. Just take my information like you do wherever you get your other information, put it all together, and then form your own conclusion. I'm not making you a recommendation here. Here's what I'd be looking at though. Gaps, not always, and some people really poo-poo this, but I'm just basing it on my experience. This idea that gaps always get filled, right? They don't. Of course, they don't always get filled, but man, they do get filled a lot. Take a look at this. So here we gapped down in September, right? Boom. That's basically opening up significantly lower in this case than where we closed. And lo and behold, the market caught itself right here just long enough to go up and fill that gap, and then it rolled over for quite some time here in October. The logic there, and it is on all of these support and resistance levels. I mean, think of it back here. So here you are, boom, 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 right? And then we break out, right? So the folks who didn't buy the breakout are now living with the remorse of watching what could have been, right? And so now what they do is they say, my gosh, if I could get a second shot at this, at that level, man, I would take it because I'm really bullish, right? Well, as you can see, and this often happens, you don't want to wait till right there because you believe everybody else is going to jump in. So people started buying that ahead or above that, what was now support, right? And it, boom, kind of tested it again, and it just kind of worked. Here we were up against it, had some news or what have you, and just boom, lost it, right? So it could be, right, that buyers here had stop losses just underneath that. But then you have kind of the opposites, right? Shoot, I should have got out if I get another chance, and boom, I got another chance and I got out. So for what it's worth, the market is simply what people think about it. And right now there's, like I said, myopia rules. And so this is the sort of thing to think about. So what do we have here? We have two gaps. So we can play that same game and say, okay, so the people who missed that big pop may want to buy it right here. And so you could see, the market come back and test that and maybe find some support there. Breaks down below, we get another shot here. Breaks down below, and maybe there's some support here, but I suspect that when we break these things with momentum, that happens when the next leg of the bear market really begins to unfold. Now, if the economy starts picking up, the stock market had a heck of a week. There's a thing called reflexivity, and it's real. It's just essentially the reflexive action is that creates all this optimism. People get out and say, hey, market's back on. We can go spend money again. And it fuels more inflation, yada, yada. And the market trades off on the next inflation news. Then we're still not at that point where the market's selling off on recession. So I think I'm beginning to ramble a bit here. Let me look at the 3-year weekly chart. You can see 1800-ish. Looks like it could be some resistance. That is a massive weekly candle. That is just huge, right? And by the way, folks, the most massive candles, by the way, up candles, ironically, tend to happen during bear markets, right? Look at that. I mean, boom, that is just a huge week. And then look what followed, right? So again, not making a prognostication. Here you are coming off the bottom, massive candle, right? Here you are coming off the bottom, massive candle, right? Massive candle right at the top, massive candle right at the top. So, be careful trading this. It could have a lot more oomph to go. I mean, this is the season, right? November, December. People like November, December in the market. So, there could be just that emotional FOMO, rush to the market. I will say this, last week coming into this, we had really, really bearish sentiment. This week, our fear greed indicator has moved slightly into the net greed column. But that's not the case in the Citigroup, which everybody follows. The Citigroup fear greed barometer is actually still in the net fear column, and that would be bullish for stocks. Last week's AAII, Individual Investor Survey, was the lowest it's been, or the highest bearishness of the year. That's going to change next week, I think, because people just change when the market changes, change their mind. But short interest, these are other things that we look at. Short interest on SPY, the S&P 500 ETF, is crazy low. That shows complacency. The VIX down below 15, that shows complacency. Put-call ratio is still elevated enough to say that there's some fear reflected in the options market. Net exposure in NASDAQ 100 futures contracts among non-commercial traders, and we look at traders across different categories, but that's the one we use for this. And they're net long, so that's bearish, meaning that's bullish sentiment. SPX futures just turned net long barely for the first time in weeks and weeks. So that means less bearishness out there. And again, for the sentiment indicator, which was very bullish going into this week, which means investors were very bearish, right? They were all piled up on the bear side of the boat. As they come over, they tend to come over, too big, particularly when we get a rally like this. And then suddenly you got all these people on the bull side of the boat, and you get something that scares them, and boom, they run to the bear side of the boat. So hope that all makes sense, but you never know on a short-term basis. I think I intimated what I'd be thinking about right here. And I know I've thought that many times before, and the market just kept ramping up as more data came out. And next week, there's going to be a whole slew of Fed speakers. Some of them are speaking more than once. So we'll see. This last week in the market might have them pause a little bit with their comforting rhetoric. And they might say, hey, folks, don't forget, inflation's there. Looking at the Conference Board's Consumer Sentiment Index, and they do take inflation expectations into account. And if they come out hawkish, we could see an abrupt reversal in this last week's rally. Not forecasting that, but I'm just seeing risks out there. Clients in our core allocations, where we're at, right? We had a really good week last week, particularly the second half of the week as well. We love it. And it wasn't all in stocks, right? It was in other places as well. But we are remaining pretty high cash positions right now, or short-term treasuries. We did add back some duration this last week, and we've been rolling the hedges. We managed them in a way where we had a really good experience that last week or two of October. Then we had to roll them in a way that allowed us to catch a big chunk of this week's rally that we pretty much did from Tuesday on. So anyway, folks, I'll stop rambling there. Thank you, as always, for watching and listening. Hope you have a wonderful weekend. Be back next week. Bye-bye.